Greetings, everyone. Today, we are going to be learning about how to take advantage of net unrealized appreciation treatment on appreciated company stock held within your 401k plan. My name is Clay Hostetter, and I am the Director of Tax Planning here at Raymond Gorell Wealth Management. Net unrealized appreciation can be a complex topic, so if you or someone you know could benefit from this information or other services our firm offers, please reach out for a complimentary consultation with our team, where we will take a look of your financial situation to determine opportunities for optimization from an employer benefit, executive compensation, investment, tax, estate, and retirement planning perspective. Net unrealized appreciation, or NUA, is one of the most lucrative tax strategies available within the Internal Revenue Code. NUA allows employees to decrease the tax bill on appreciated shares of company stock owned within a 401k plan. In order to fully understand the benefits of this strategy, it is important to know what normal distribution options are for company stock held within 401k plans. The first option is to roll over the stock in the 401k plan to an IRA and continue deferring taxes. This eliminates the availability of NUA strategy, and normal distribution rules will apply for distributions taken from a Roth or traditional IRA account. The second option is to take a distribution directly from the 401k plan and pay ordinary income taxes on the full amount. This also disqualifies an individual from taking advantage of NUA treatment. The third option is to utilize net unrealized appreciation treatment on the common stock and move it into a brokerage account, allowing the employee to reap favorable capital gain treatment on the appreciation or growth that has occurred. Let's take a look at how this actually works. First, an employee must be eligible for a distribution from their qualified plan, generally at retirement or age 59 and a half. The employee takes a lump sum distribution from the plan, distributing all of the assets from the plan during a 1-year period. The portion of the plan that is made up of mutual funds and other investments can be rolled into an IRA for further tax deferral. The highly appreciated company stock is then transferred into a brokerage account. At this time, the NUA rule is applied, and the employee will incur an ordinary income tax liability on only the cost basis of the company shares. The appreciation of the stock above its cost basis while in the 401k is not taxed at the higher ordinary income tax rate, but at the lower long-term capital gains rate, typically 15%, but in some instances as low as 0%. This could mean a potential savings of 20%. To better understand the benefits of this strategy, let's put some numbers to it. We will assume the value of the company stock within the 401k plan is $500,000. The cost basis or price paid for this stock is $75,000. If one rolled the entire amount into an IRA, they would owe nothing in taxes at the present time. However, when these dollars are eventually distributed, the employee would pay $120,000 in taxes, assuming a 24% marginal federal tax rate. If instead this employee chose to utilize net unrealized appreciation treatment on these shares, they would pay ordinary income taxes on the cost basis at the time of distribution. This totals $18,000 in tax liability today. However, assuming a 15% long-term capital gains rate, the taxes paid on the net unrealized appreciation would be 15% of the gain, or $63,750. This brings the total tax liability under NUA treatment to $81,750. In this example, the employee saved over $38,000 in taxes by utilizing NUA treatment. However, if the employee were to receive a 0% long-term capital gains rate through the advanced tax planning our team of CPAs provide, this tax savings could jump over $100,000. While this strategy can seem like an absolute win from a tax perspective, there are a few important factors to keep in mind. NUA only makes sense when an employee has low cost basis company shares within the 401k plan. It is not uncommon for employees to accumulate low cost basis shares due to long-term growth and market turmoil over the years. Stock shares must transfer in kind to a taxable account. This means that the shares must not sell, but must move from the 401k plan into the new taxable account. It also is important to take advantage of the NUA rule prior to a rollover or partial distribution from the 401k plan. Once the retirement assets have been rolled into an IRA, it is too late to take advantage of these tax savings. Thanks again for spending some time with us today to learn about net unrealized appreciation treatment. At Raymond Gorell Wealth Management, we have over $1 billion in assets under management. As a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. Our team of CFP and CPA professionals specialize in helping clients take advantage of advanced financial strategies to materially enhance their ability to enjoy life before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.